Welcome to a brand new deep dive. And today we have a really fascinating one for you.
We really do. And it's a pretty wild story.
Yeah. Okay, let's unpack this because I want you to imagine that you run a multi-billion-dollar tech company, right?
Right. High stakes.
Exactly. And your flagship software app is just glitching. I mean, constantly glitching, causing this highly publicized consumer revolt.
Which is a nightmare scenario for any hardware brand.
Totally. Plus, the global economy is a mess. Inflation is squeezing the middle class. And international tariffs are threatening to just wipe out your profit margins.
It's basically a perfect storm of terrible conditions.
Right. So what do you do? Because if you're Sonos, you do something entirely counterintuitive.
Yeah, you basically just stop.
You stop. You halt the hype machine, you go completely dark on the innovation front to just tear your own house down to the studs.
Which, I mean, it completely defies the standard Silicon Valley playbook.
And somehow, by doing that, they managed to make an entire year's worth of profit in just 90 days.
It's incredible. We are so conditioned to believe that hardware companies only survive through, this relentless cycle of new releases.
Like you need a flashy new gadget every 6 months just to keep the lights on.
Exactly, just to keep investors happy. But what we are looking at today with this Q1 2026 earnings call from Sonos, featuring CEO Tom Conrad and CFO Saori Casey, it's a total rejection of that blockbuster mentality.
So for all you retail investors listening, the mission of this deep dive is to explore how a consumer hardware company manages to engineer this massive financial turnaround.
If we connect this to the bigger picture, this isn't just about selling speakers, right? It's really a masterclass in ecosystem economics.
Yeah, and the agonizingly difficult work of rebuilding consumer trust from the ground up. We want to decode their actual playbook for what they call durable growth.
Because if you look around your living room right now, you probably have, a dozen smart devices.
Oh, easily. The TV, the smart thermostat, the lighting system.
Right, maybe a smart speaker or two. But how many of those devices actually work together flawlessly?
Very few. Most of them are just, isolated, stubborn little gadgets.
Exactly. They demand their own separate apps, their own updates, and your constant attention.
That tension is exactly what we are going to explore today. So let's start with the sheer shock of these Q1 financials.
Because they really were a shock.
They were. When I first read the headline numbers, I honestly thought I was missing something.
Let's hit those data points. What did they bring in?
So the headline revenue came in at $546 million, and management noted that this actually beat the midpoint of their internal guidance.
Which sounds great on the surface.
It does, but here's the thing that caught me off guard. That revenue number is actually down 1% year over year.
Right, they generated less top-line revenue than they did a year ago.
And normally, if a growth-oriented tech company posts a year-over-year revenue decline, Wall Street absolutely punishes them.
The stock usually tanks. The narrative instantly becomes that the growth story is dead.
Right. So how did they avoid that?
Well, that conventional wisdom entirely misses the leverage equation they've managed to achieve here.
Okay, break that down for us in plain language.
The absolute standout metric, the one that changes the entire story for anyone considering this stock, is their adjusted EBITDA.
Okay, let's pause right there. We throw around acronyms like EBITDA a lot on this show, and I want to make sure everyone is on the same page.
Good call.
It stands for earnings before interest, taxes, depreciation, and amortization. It is a total mouthful.
It really is.
Why does Wall Street care so much about EBITDA, especially for a hardware company? Why not just look at net income?
It's a really vital distinction. Net income is what is left over after absolutely everything, including these accounting realities that don't actually reflect the day-to-day operations.
Like what? Give me an example.
Well, depreciation is a great example. Say Sonos builds a massive new testing facility. The cost of that building depreciates over decades.
Right, so the tax accountants take a chunk out of the profits on paper for that depreciation.
Exactly. But that doesn't actually tell you how well the company is selling speakers this week.
Okay, so EBITDA strips all that away.
Yes, it strips away the tax strategies, the debt interest, the accounting stuff. It gives you the raw, unvarnished pulse of the core business.
It basically asks, are the actual operations of designing and selling these speakers generating cash?
Precisely. And that number, that raw operational cash engine, hit $132 million for the quarter.
Which is a 45% growth year over year.
Yes, a 45% jump in operational profit, while revenue was down 1%.
And the statistic that absolutely blew my mind when I was reading through the analyst notes, This single quarter of EBITDA matched the entirety of their fiscal 2025.
One single quarter matched a whole year of operational profit.
Here's where it gets really interesting to me. They basically paused releasing new hardware last year.
Right, they went completely dark.
So how does a hardware company make record profits without new hardware? If I'm a restaurant and I stop introducing new menu items and I serve slightly fewer customers, how does my profit suddenly skyrocket by 45%?
You achieve it through an aggressive, almost surgical dismantling of your cost structure.
So just cut everything.
Basically, yes. CEO Tom Conrad and his team executed what they call the $100 million run rate savings initiative over the last 18 months.
$100 million in savings. That is massive.
It is. And to understand how radical that is, we really have to look at where that money came from.
Because it isn't just about finding cheaper paper clips for the office, right?
No, not at all. They slashed their operating expenses, their OPEX, by roughly 20% year over year.
Wait, 20%? I have to challenge that a bit because in my experience, cutting 20% of an operating budget usually means mass layoffs.
Yeah, or deferred maintenance.
Right, it's like corporate anorexia. You cut so much that you literally don't have the muscle left to build the next product.
That is definitely the danger of blunt cost cutting.
Right.
But let's look at the actual mechanics of what Sonos did here.
Okay, where did the 20% come from?
A significant portion came from re-architecting their cloud infrastructure.
Cloud infrastructure, like server costs.
Exactly. When you have more than 53 million connected devices sitting in people's living rooms, those devices are constantly pinging your servers.
Checking for updates, verifying streaming licenses, that kind of thing.
Yeah, syncing data, all of it. That requires massive, expensive contracts with cloud providers like AWS or Google Cloud.
So how did they cut that?
By optimizing the code. They made the devices communicate more efficiently.
Oh, wow. So they just made the software less bloated.
Right. And then they renegotiated those server contracts during a period when cloud providers were competing fiercely for enterprise business.
So the speaker on my kitchen counter is literally cheaper for Sonos to operate today than it was a year ago, purely because they tightened up the back-end code.
Yes, exactly. Without the customer ever noticing a difference.
Right.
But they also optimized the physical supply chain.
Okay. The actual shipping of the boxes.
Right. During the pandemic, global shipping rates were just astronomical. Companies were paying exorbitant spot market prices.
Just to secure space on container ships.
Yeah. But over the last 18 months, as global logistics normalized, Sonos aggressively renegotiated their freight contracts.
So the cost of moving a soundbar from a factory in Asia to a warehouse in Chicago dropped significantly.
Significantly. And then you also have to factor in the marketing spend.
Oh, right. Because if you aren't launching a new flagship product, you don't need to buy a $7 million Super Bowl commercial.
Precisely. You don't need massive billboards in Times Square. The hardware pause forced a marketing pause.
And when you combine the cloud savings, the logistics savings, and the reduced marketing spend, you get a highly leveraged business model.
Highly leveraged. CFO Sayori Casey noted that their adjusted EBITDA margin hit 24.2%.
Which is an increase of 760 basis points. Let's translate that for the listener really quick. A basis point is 1/100th of a percentage point.
So we are talking about a 7.6% jump in profit margin.
Which in the hardware world, where margins are traditionally razor thin, a 7.6% margin expansion is massive.
It means for every $100 that comes in the door, they are keeping almost $8 more than they did last year.
And we see the ultimate result of that in their cash generation.
We do. They generated $157 million in free cash flow, which is up from $143 million the previous year.
And they even spent $25 million buying back their own stock at an average price of $16.79.
Stock buybacks are such an interesting psychological signal to Wall Street.
It's management basically broadcasting, We stabilized the ship, we have more cash than we know what to do with, and we think our stock is undervalued.
It is a total flex.
It's a flex, but I think we have to maintain a healthy skepticism here.
Absolutely.
Earning more while selling slightly less volume is a fantastic triage strategy. It stops the bleeding.
But you cannot cost cut your way to long-term market dominance.
Right. Eventually, you run out of server contracts to renegotiate. You reach the floor of your operating expenses.
At some point, the rubber has to meet the road. You actually have to grow the top line.
You have to convince new human beings to part with their hard-earned money and bring your products into their homes.
Which is exactly the transition point the company is at right now. The defensive phase is over.
So what's the offensive phase?
Well, CEO Tom Conrad spent a significant portion of this earnings call detailing the underlying philosophy that will drive that top-line growth.
Okay, let's hear it.
It is a concept he refers to as systemness.
Systemness. I have to be honest, that sounds a bit like an academic buzzword.
It does sound like something a tech philosopher would coin, right?
Totally. Something to sound smart at a conference. But when you dig into what he actually means by it, it changes how you view their entire product lineup.
It's a very deliberate choice of terminology. Most hardware companies view themselves as widget makers.
You make a great television, you sell it, the transaction ends.
Exactly. You make a great Bluetooth speaker, you sell it, the transaction ends. But Conrad's central thesis is that Sonos is not a collection of isolated products.
It is a system that inherently gets more valuable as you add to it.
Yes, and this is the fundamental economic engine of the company.
So what does this actually mean for the listener? Let's explore that concept of appreciating utility because it is exceptionally rare in the physical world.
It really is.
Like, if I go out and buy a stunning, top-of-the-line 4K television for my living room, my old television in the bedroom doesn't magically get better.
If anything, it feels worse by comparison.
Right. They don't talk to each other. They are completely siloed experiences.
But if you buy a new Sonos soundbar for that living room TV, and you already have a small Sonos speaker in the kitchen, suddenly the entire network of your home audio is more versatile.
Exactly. I can group them together to play the same Spotify playlist seamlessly while I'm walking between rooms.
Or you can start a podcast in the bedroom and instantly transfer the audio to the bathroom while you're getting ready for work.
The addition of the new hardware literally unlocked new functionality for the old hardware.
And this brings us to a crucial point about consumer psychology and economic moats.
Let's look at the journey of a customer.
When a person buys their very first Sonos speaker, maybe just an entry-level device for their desk, they are a consumer.
They're just testing the waters, evaluating the sound quality and the app interface.
But when that same person buys their third speaker, or when they invest in a full home theater setup, a psychological shift occurs.
They are no longer just a consumer, they are a resident of the ecosystem.
They have bought into the systemness.
Yeah.
And breaking out of that ecosystem is incredibly painful.
The friction is huge. If you have 5 Sonos speakers hardwired into your daily routine, and you suddenly decide you want to try a completely different brand for your backyard patio,
You are actively choosing to break the system.
you're choosing to download a separate app, manage separate updates, deal with audio that won't perfectly sync with your kitchen.
The friction of leaving is so high that most people just default to buying another Sonos product.
And this is where the financial upside becomes staggering. Let's look at the math Conrad laid out on the call.
The $12 billion math.
Yeah, break that down for us.
He noted that their current multi-product households, the people who've already bought into the ecosystem, have an average of about 4.5 devices.
Okay, 4.5 devices per home.
He stated that if they can move that average from 4.5 devices to 6 devices, that simple incremental change represents roughly $5 billion in additional revenue.
I want to make sure I'm grasping the scale of that. $5 billion.
Yep.
And they don't even need to acquire a single new customer to unlock that money.
Not a single one.
They don't need to run a single advertisement to people who have never heard of Sonos. They just need to keep their current super users happy enough to eventually add 1.5 more speakers over the coming years.
That is the magic of minimizing customer acquisition costs. In the modern tech landscape, acquiring a new customer is brutally expensive.
Oh yeah, companies spend hundreds of dollars on Facebook and Google ads just to convince one person to buy a $200 gadget.
But if the system itself drives the repeat purchase, if you buy the 5th speaker simply because the first 4 work so well together, your marketing efficiency goes through the roof.
But the math Conrad presented gets even larger, doesn't it?
He does. He also pointed out that converting their current single-product households into multi-product households represents an additional $7 billion in upside.
Okay, so $5 billion from expanding the super users, plus $7 billion from upgrading the casual users. That is a $12 billion opportunity just sitting completely dormant within their existing installed base.
And it's crucial to remember that this is before you even look outside their current customer base.
Right.
Conrad mentioned a statistic that completely frames the broader opportunity. Sonos currently holds only about 6% of the $24 billion global premium audio market.
I have to say, I am genuinely surprised by that 6% figure.
It seems low, right?
It really does. When you hear the name Sonos, you assume they absolutely dominate the entire landscape. They feel ubiquitous in a certain demographic.
But to hear that 94% of the premium audio dollars globally are still going to other brands, or traditional wired systems, or Bluetooth silos.
It shows how much of a greenfield opportunity still exists.
It highlights a massive runway for growth. But here's the rub. A system only works if the foundation is solid.
Right. People will only buy that sixth speaker if the first 5 work flawlessly.
If the app crashes when you try to group the living room and the kitchen, the illusion of systemness shatters.
So to capture that $12 billion upside, and to aggressively chip away at that 94% of the market they don't yet own, they can't just rely on theoretical economics.
No, they had to lay out a very specific operational playbook.
Which brings us to the core of the earnings call. They laid out 5 specific growth dimensions.
This is the actual roadmap for how they transition from defending their margins to attacking the market.
Let's walk through these dimensions, because this is where the strategy gets incredibly tactical.
Growth dimension number 1 is product innovation.
And this signals the definitive end of their hardware pause. They are officially back to introducing new products into the market.
The specific example they highlighted was a device called the Amp Multi, which they announced is launching in the second half of fiscal 2026.
Now, I have to be completely honest here. When I first read the press release for the Amp Multi, I was totally underwhelmed.
Oh, really? Why is that?
Well, when you think of a tech hardware launch, you think of a sleek new sound bar, or a revolutionary new portable speaker with a stunning design.
Right, something flashy.
But an amplifier, it's basically a black box that sits in a networking closet. It doesn't sound sexy at all.
It doesn't. But when you dig into who this product is actually built for, the strategy is brilliantly subversive.
Okay, explain that. Who is it for?
It requires looking at the market from a business-to-business perspective, rather than purely business to consumer. The Amp Multi is not designed for the average person to pick up off a shelf at Best Buy.
Okay.
It is engineered almost exclusively for professional installer and integrator partners.
Ah. These are the highly specialized contractors who build complex multi-zone audio systems directly into the architecture of custom homes.
Right, the people who come in before the drywall even goes up, they are running miles of speaker wire through the studs, putting speakers in the ceilings of the bathrooms, out on the patio, in the home theater.
Conrad noted on the call that professional installers actually make up 22% of Sonos' entire business.
Which is a massive, highly lucrative chunk of their revenue stream.
So by creating a product like the Amp Multi, which combines flexible amplification with simpler tuning software, they are fundamentally making the installer's life easier and more profitable.
They're helping that contractor take on larger projects, finish them faster, and reduce the number of callbacks they get for technical glitches.
I am obsessed with this B2B2C strategy. By making the hardware explicitly easier for the professionals to install and manage, Sonos is effectively turning these high-end luxury contractors into an unpaid, highly motivated sales force.
Think about the dynamics of building a custom home. If you are spending millions of dollars building a house, and your AV guy, the expert you hired, says, I highly recommend we use the Sonos Amp Multi as the brain of the house because it's the most reliable system.
You aren't going to argue with him. You're going to look at the blueprint and say, great, put it in.
Exactly. And suddenly, before the homeowner has even moved their furniture in, Sonos is literally hardwired into the real estate.
Talk about durable growth. You cannot get more durable than being physically built into the walls of a house. The switching costs are astronomically high. You'd have to hire someone to rip out your drywall to change the system.
It creates an incredibly sticky, high-value relationship, not just with the affluent homeowner, but with the professional channel itself.
The installer becomes an evangelist for the brand.
But, and this is a massive but, that installer is putting their own reputation on the line when they recommend Sonos.
Right. If the system fails, the homeowner doesn't call Sonos customer support. They call the installer and yell at them.
Which leads directly into growth dimension number 2, customer advocacy.
Ah, yes. The great trust rebuild. Because we have to acknowledge the reality of the situation here.
2025 was a brutal year for the Sonos user base.
Brutal. They rolled out a major app redesign that was, by all accounts, a disaster.
Essential features were missing, systems wouldn't connect, speakers would just drop off the network.
I mean, the internet was flooded with furious super users who suddenly found that thousands of dollars of premium audio equipment had been bricked by a bad software update.
It was a textbook example of how fragile an ecosystem can be.
Huh.
And Conrad addressed this head-on during the call.
Right. The entire hardware pause we discussed earlier was initiated specifically to focus all engineering resources on strengthening that software foundation.
He detailed that in Q1 alone, they rolled out 10 separate software upgrades, specifically targeted at improving performance, speed, and reliability.
I want to linger on that for a second because pushing 10 software updates in a single quarter is a frantic pace for a hardware company.
It is a massive undertaking.
What were they actually fixing? What makes updating a smart speaker system so much more fraught than, say, updating a social media app on your phone?
The complexity stems from the fact that a Sonos system operates across multiple distinct environments simultaneously.
What do you mean?
When you update a phone app, you are just downloading new code to a single, highly standardized device. But when Sonos pushes an update, they are updating the app on your iPhone, the app on your partner's Android, the firmware on the 5-year-old speaker in your bedroom, and the firmware on the brand new soundbar in your living room.
And all of those different silicon architectures have to talk to each other perfectly over your home's unique Wi-Fi network.
Which is likely dealing with interference from your microwave and your neighbor's router.
Wow, yeah. Furthermore, they are constantly authenticating with dozens of third-party cloud services like Spotify, Apple Music, and Alexa.
It is a highly complex, multi-node network problem. So when the app redesign fundamentally changed how those nodes communicated, the latency spiked and the system broke down.
Some users complained it was relying too heavily on cloud servers rather than local network traffic.
Exactly. Pushing 10 updates in 90 days shows an all-hands-on-deck crisis response to rebuild that local network reliability.
And Conrad noted that these relentless improvements are finally showing up in the telemetry data, right?
Yes, and in higher customer satisfaction scores across all their channels. He framed this brilliantly, stating, "System reliability is not just a quality metric for us, it's a growth driver."
Because when the system is flaky, customers stop using it, and they certainly don't buy more devices.
So when it works flawlessly, they trust it, they expand it, and crucially, they recommend it to their friends.
You can have the best marketing in the world, but if the app doesn't work, you're dead in the water. Rock-solid reliability is the absolute prerequisite for unlocking that $12 billion lifetime value.
Speaking of marketing, that brings us to growth dimension number 3, marketing.
And they have a completely new perspective on the executive team here. Enter new CMO Colleen DeCourcy.
She had only been in the role for 3 weeks at the time of this earnings call, but she is already telegraphing a massive shift in how the company communicates with the public.
The strategy shifts away from what Conrad called episodic spikes.
Historically, the entire consumer electronics industry relies on these spikes. You spend tens of millions of dollars on a massive coordinated advertising blitz only when a new flagship product launches.
Like Apple's September events. It creates a massive spike in cultural awareness, a surge in sales, and then the marketing goes relatively quiet until the next launch.
The new strategy under DeCourcy is focused on sustained, persistent brand storytelling throughout the entire year.
Now, I have to say, I am deeply skeptical of that approach for hardware. It sounds lovely in a marketing seminar, but does it actually move product?
It's a fair critique. An analyst actually challenged them on this during the Q&A portion of the call, asking directly if this meant we should expect a massive, splashy Super Bowl commercial to announce their return to form.
And what did Conrad say?
He skillfully deflected the Super Bowl idea, emphasizing that durable growth requires compounding improvement, not a flash-in-the-pan commercial that costs $7 million for 30 seconds.
So the logic is that because Sonos is selling an ecosystem rather than a single gadget, the messaging needs to be educational and continuous.
Exactly. They want to shift the consumer narrative from look at this shiny new speaker model to here's why the Sonos ecosystem is fundamentally the most intelligent way to manage audio in your home. And here's how it gets better the longer you own it.
It is ecosystem-centric marketing instead of hardware-centric marketing.
Right. It's an attempt to sell a paradigm rather than a product.
It will be fascinating to see if they can execute that without getting drowned out by competitors with louder megaphones. Which brings us to dimension number 4, geo expansion.
And the regional data they provided here was a bit of a mixed bag.
Yeah, let's look at those numbers. The Americas region grew by 1% year over year, but EMEA, which is Europe, the Middle East, and Africa, declined by 4%.
And APAC, the Asia-Pacific region, was down 5%.
On the surface, shrinking in major global markets looks like a major red flag for investors.
However, context is paramount here. You cannot look at those regional declines in a vacuum. You have to look at them relative to the broader macroeconomic environment in those regions.
Because the global economy is struggling overall.
Exactly. Sayuri Casey pointed out that while the overall regions dipped slightly, specific growth markets within those regions continue to outpace their legacy core markets.
But more importantly, Conrad highlighted a vital statistic. Despite the slight regional revenue declines, Sonos is actually gaining dollar share in the premium home theater category in both the US and EMEA.
Let me make sure I'm translating that correctly for the listener. The the total amount of money consumers in Europe are spending on home theater equipment right now shrank.
The market as a whole contracted.
But Sonos's specific slice of that shrinking pie actually got bigger.
So they're actively outperforming the broader market decline and taking revenue away from their competitors.
Precisely. They are consolidating their power in a difficult environment. When the market is down, weaker brands get wiped out, and premium brands with strong ecosystems tend to capture whatever remaining demand exists.
And the fifth and final growth dimension they listed is external trends, specifically tapping into the massive proliferation of conversational AI.
But I think we should bookmark that.
Yes. We're going to explore their AI strategy much deeper in our final segment because the way they are approaching it is fundamentally different than almost anyone else in tech right now.
Agreed. It is the most forward-looking part of the call. But before we get to the future, we have to deal with the harsh realities of the present.
Absolutely. Because they have a brilliant strategy on paper, the 5 dimensions make logical sense. But in the real world, hardware companies are currently fighting a brutal economic war on multiple fronts.
You have sticky inflation altering how consumers spend their paychecks.
You have geopolitical tensions threatening global supply chains. You have fluctuating commodity costs.
Which brings us to the macro minefield they are navigating.
Let's start with the consumer themselves. During the Q&A, an analyst brought up a concept that we've been hearing a lot about lately, the K-shaped economy.
It is a critical macroeconomic concept for understanding the current retail landscape.
Explain it for us.
A K-shaped economy describes a situation where different segments of the economy, usually divided by income or wealth, recover or grow at entirely divergent rates.
Like the physical arms of the letter K. The top line angles upwards and the bottom line angles downwards.
Yes, it's the economic visualization of the phrase, the rich get richer and the poor get poorer. It indicates a stark divergence in economic fortunes.
And Tom Conrad noted that this K-shaped divergence is exactly what Sonos is observing in consumer purchasing behavior, particularly regarding premium home theater equipment.
He stated that they are seeing robust, growing demand for premium, high-end experiences representing the top arm of the K.
So wealthier consumers who are insulated from day-to-day inflation through asset ownership are still actively spending thousands of dollars to outfit their living rooms with immersive surround sound systems.
However, he also noted diminishing demand for entry-level experiences, the bottom arm of the K.
So the average consumer, the person who might normally walk into a big box store and buy a basic $250 soundbar just to upgrade their TV speakers, is feeling the severe pinch of grocery inflation and housing costs.
Exactly. If they don't need a new speaker, they aren't buying one. The middle has essentially hollowed out.
Now, Conrad mentioned that Sonos's product portfolio is structurally well-positioned to take advantage of that premium demand. They have high-end soundbars like the Arc and expensive subwoofers that cater perfectly to the top arm of the K.
But from a strategic standpoint, they absolutely could not afford to just ignore the bottom arm of the K.
Why not? If the premium stuff is selling, why care about the entry level?
Because if fewer average people are entering the market at the entry level, you have a massive existential problem for your long-term ecosystem math.
The $12 billion equation.
Right. It relies entirely on new users eventually becoming super users. If the entry pipeline dries up, the future growth engine stalls.
And this leads to what I think is the most fascinating, aggressive, tactical move they made in the entire quarter. I call it the gateway strategy.
It's a great term for it. Confronted with a tough entry-level market where consumers are terrified to spend money, Sonos explicitly lowered the price of their entry-level standalone speaker, the Era 100.
By the way, the automated transcript phonetically spelled this as the Aero 100, but based on their product line, we know they're referring to the Aero 100.
The decision to reduce the price of the Aero 100 was deeply intentional and highly calculated. CMO Casey noted it was part of a broader pricing strategy initiated to drive overall gross profit dollars, even if it meant sacrificing a bit of margin on that specific device.
And the data shows it works spectacularly. Q1 marked the third consecutive quarter of accelerating new customer growth for households starting their Sonos journey specifically with this device.
Let's talk about the scale of that growth. New customer adoption for the Aero 100 surged over 40% year over year.
A 40% spike in a macro environment where most consumers are aggressively cutting back on discretionary electronics.
It's wild.
I look at this strategy and it feels like a classic loss leader playbook or, frankly, a gateway drug strategy.
Like Gillette selling the razor handle at a massive loss because they know you'll spend hundreds of dollars on the razor blades over the next 5 years.
Exactly. By making the entry point to the Sonos ecosystem cheaper, they are actively choosing to take a hit on the upfront profitability. They get that relatively affordable Aero 100 onto your kitchen counter, and they're betting the entire company on the idea that the systemness will take over.
It is a calculated gamble on human behavior. Conrad confirmed this during the call, stating that historical data shows customers who start their journey with the Aero 100 exhibit incredibly strong repurchase behavior.
Once they experience the ease of use, they buy the second speaker for the bedroom or the soundbar for the living room.
And crucially, he noted that this historical pattern of repurchase is continuing to hold true with these massive new cohorts of buyers they just acquired through the price drop.
So they are trading immediate short-term margin on a single piece of plastic and silicon in exchange for a highly predictable long-term customer lifetime value.
It is a brilliant play, assuming the software holds up. But speaking of margins and the cost of physical goods, we have to talk about the absolute nightmare that is the global supply chain.
Oh, tariffs. I want to spend some time here because geopolitics is actively messing with everyone's balance sheets right now.
It is unavoidable. CMO Casey revealed during her financial breakdown that tariff expenses were an approximately 300 basis point headwind to their gross margins in Q1.
Again, for the retail investor listening who doesn't breed financial jargon, 300 basis points is a flat 3%.
In the physical hardware world, where you are dealing with complex bills of materials, shipping containers, and warehousing, a certain 3% reduction in your gross profitability is a catastrophic blow.
It is the kind of hit that can completely wipe out a company's bottom line and send them into a defensive spiral. You are losing 3% of your profit margin purely because of taxes on moving boxes across international borders.
How does a company whose components are globally sourced even survive that kind of geopolitical shock?
That's the million-dollar question.
What is genuinely fascinating here is not the hit they took, but how effectively and quietly they neutralized it. Casey explained that they mitigated nearly all of that 300 basis point tariff headwind through strategic price adjustment that they implemented towards the end of September.
Wait, let me stop you there. Are you saying they just raised the prices on the consumer end? They passed the tax directly to the buyer?
In targeted areas and on specific products, yes. They adjusted the retail pricing matrix to absorb the tariff costs.
But didn't we just spend the last 10 minutes talking about how the consumer is tapped out? How the K-shaped economy means people are terrified of spending money?
We did.
If you raise prices in this environment, shouldn't your sales absolutely crater?
That is the ultimate test of a premium brand's economic moat. Economists call this price elasticity of demand.
Okay, explain that.
If you are a commodity brand, say, you make generic Bluetooth speakers and you raise your price by $20, consumers will instantly abandon you and buy a cheaper generic brand.
You have high price elasticity.
But if you raise prices and consumers grumble, but ultimately still buy your product, you have low price elasticity. You have true pricing power.
And the fact that Sonos could surgically raise prices on certain items to offset a 3% tariff hit without destroying overall consumer demand speaks volumes about the perceived value of their ecosystem.
People value the lock-in of the Sonos network enough that they are willing to absorb a slight price increase, allowing the company to maintain its overall gross margin profile despite the geopolitical chaos.
It is the ultimate flex of brand power. But tariffs aren't the only supply chain nightmare keeping hardware executives awake at night. What about the global panic over memory costs?
RAM.
If you follow the tech sector right now, everyone is screaming about RAM. The price of random access memory is inflating wildly, and it is freaking out investors across the board.
Yes, and an analyst named Stephen Frankel brought this specific issue up during the Q&A session, directly asking management about the rising costs of memory and whether it could potentially gate the production of their highly anticipated new products in the back half of the year.
Because if you can't get the memory chips at a reasonable price, you literally can't build the speakers. Or you build them and lose money on every unit.
Exactly. And Conrad's response here is critical because it highlights a fundamental architectural advantage that Sonos possesses over almost every other consumer electronics manufacturer.
What's the advantage?
First, on a tactical level, he assured the analyst that their supply chain team had already proactively secured and certified additional secondary memory suppliers. This strategic redundancy reduces their reliance on volatile spot market pricing.
Okay, smart.
But the more profound point he made was about the fundamental computational nature of their hardware.
Let's put this in perspective for a second. Think about the smartphone in your pocket. If you go buy a new iPhone Pro or a high-end Samsung Galaxy, the marketing is constantly screaming at you about RAM. 8 gigabytes of RAM, 12 gigabytes of RAM, 16 gigs.
And they need it because your phone is basically a supercomputer.
You are running 50 apps simultaneously, rendering 4K video in real time, playing graphics-heavy 3D games, and constantly refreshing location data. The device requires massive, lightning-fast memory banks just to function.
Precisely. The smartphone industry is entirely dependent on securing massive quantities of high-end memory. But a Sonos speaker has incredibly modest computational requirements.
What are we talking about here?
Casey pointed out on the call that their devices typically use between 512 megabytes and 2 gigabytes of RAM, with the vast majority of their product portfolio containing 1 gigabyte or less.
Less than a gigabyte of RAM. My toaster probably has more memory than that. Why is it so low?
Because of what the speaker's actually doing. They don't need massive memory banks because they aren't computing heavy local tasks. They aren't rendering graphics or running a complex user interface on a screen.
Right.
A Sonos speaker is primarily a highly specialized networking device. Its job is to receive an audio stream from the cloud, perfectly decode those audio packets, perfectly synchronize the timing with the other speakers on the network down to the millisecond, and push the analog signal out to the amplifier.
It requires highly optimized processing power for synchronization, but very little raw memory storage.
And as a consumer, I don't care. No one has ever walked into a Best Buy and said, "Excuse me, I'm looking for a living room soundbar, but it must have at least 4 gigs of DDR5 memory."
It's absurd. You buy a speaker for the acoustic engineering. You buy it for the way it decodes Dolby Atmos. You buy it for the experience, not the spec sheet.
And if we connect this to the bigger macroeconomic picture, this modest hardware requirement fundamentally insulates Sonos from the worst of the silicon supply chain shocks.
Right, because right now, NVIDIA and the massive AI data centers are buying up almost all the high bandwidth memory in the world, driving the price through the roof.
PC and smartphone manufacturers are bleeding margin, trying to secure their necessary RAM allocations. But Sonos is relatively sheltered. Their bill of materials is simply far less exposed to that specific hyperinflated commodity cycle.
So if we look at the whole board here, they've utilized their pricing power to effortlessly swat away the 300 basis point tariff hit. Their fundamental product architecture shields them from the AI-driven RAM inflation panic. They've aggressively lowered the barrier to entry with the Aero 100 to capture the budget-conscious consumer, while simultaneously catering to the ultra-high-end real estate market with the Amp Multi.
It really feels like they've fortified the castle against the siege.
They have undoubtedly stabilized the foundation. The defensive maneuvers are complete. But stabilization, while impressive, is only step one.
The ultimate endgame, the real vision for the future of this platform and how they plan to capture that massive $12 billion opportunity, requires us to look forward.
Which brings us to our final act. We've talked about the past, we've talked about the present, now we are looking at the horizon. Specifically, the integration of artificial intelligence in the living room and the roadmap for the second half of 2026.
Now, management did set some very clear, somewhat tempered expectations for the immediate future. Casey provided financial guidance indicating that Q2 is going to be relatively quiet.
Yeah, they are projecting revenue between 250 million and 280 million, which effectively leaves the first half of fiscal 2026 entirely flat year over year.
Which is entirely expected given the operational realities we've discussed. As they noted, they are still operating without the benefit of new product launches to bring new customers into the system or spark a massive wave of repurchase from existing users.
Q2 is essentially the deep breath before the plunge.
The entire narrative, the entire valuation of the company right now is focused on a major acceleration and a return to aggressive top-line growth in the second half of 2026, as products like the Amp Multi and other major yet-to-be-announced hardware innovations finally hit the market.
And a massive, unavoidable part of that future narrative revolves around artificial intelligence. You cannot have an earnings call in the current tech climate without addressing AI.
True, but usually when tech CEOs talk about AI, it's just a buzzword salad. They talk about chatbots or generating weird hallucinated images or some vague promise of increased synergy.
But Tom Conrad actually broke down Sonos's AI vision into three very distinct, very practical, and highly strategic layers.
It was one of the most grounded explanations of applied AI I've heard recently.
Let's go through them. What's the first layer?
The first layer he mentioned is conversational AI. This refers to natural voice interaction, the ability to speak to your home environment. But Conrad was incredibly careful to emphasize that this interaction needs to feel invited rather than tacked on, intrusive, or far afield from their core competency.
Right, and that word invited is doing a lot of heavy lifting. Let's look at the history of voice assistants in the home.
It hasn't been great.
Amazon Alexa and Google Assistant were supposed to revolutionize our lives. But in reality, they mostly turned into glorified kitchen timers that occasionally try to sell you paper towels while you're cooking.
It feels invasive. It feels like you have a corporate spy sitting on your counter.
Conrad is basically saying that Sonos voice control needs to be an audio assistant that actually understands the deep context of music and audio rather than a general-purpose search engine trying to monetize your living room.
But it was the second layer of his AI vision that really caught my attention and made me sit up. He called it anticipatory design.
Okay, anticipatory design. Break that down for us.
Anticipatory design is arguably the holy grail of consumer technology right now. For the past decade, the tech industry has been obsessed with building the smart home. But if we are honest, a smart home is still fundamentally, frustratingly reactive.
You have to pull out a smartphone app, navigate 3 menus, and push a digital button.
Or you have to explicitly speak a command. Turn on the kitchen lights, play jazz at volume 4. It is still entirely a command and control paradigm. The human has to initiate every action.
Exactly. A smart home isn't actually smart. It's just a very fancy, highly complicated universal remote control.
Precisely. Anticipatory design seeks to move us past the remote control era. It aims to transition us from smart homes to genuinely intelligent homes.
What's the difference?
An intelligent home doesn't sit idly waiting for a command. It acts on your behalf before you even ask.
Wow.
Conrad described a vision for system features that understand who you are, what mood you are in, what time of day it is, and exactly what room you just walked into, and then seamlessly playing exactly the right content with zero manual input required.
Okay, I have to stop you because I am experiencing a massive collision of awe and deep skepticism here.
I get that.
You're telling me the house just knows that I need upbeat, high-tempo jazz because it's a Tuesday at 6 p.m. and I'm aggressively chopping onions in the kitchen? I mean, structurally, that sounds like a sci-fi utopia.
It does.
But pragmatically, how? How does a plastic box on my counter actually know what I want? Are there hidden cameras? Are there sensors tracking my heart rate? Is it syncing with my calendar to see if I had a bad day at work?
It doesn't need cameras or calendar access. It relies on the massive aggregation of contextual data. And this is exactly where Sonos's massive historical installed base becomes an insurmountable competitive weapon.
Okay, walk me through that.
Conrad noted on the call that they currently have more than 53 million connected devices actively deployed across 17 million homes globally.
That represents a staggering, almost unimaginable amount of telemetry data regarding human listening habits.
They know which rooms are grouped together at what times. They know the average volume levels on a Sunday morning versus a Friday night. They know the precise sequence of system interactions.
So when you feed that sheer volume of historical data into modern machine learning algorithms, the system can begin to spot highly accurate predictive patterns about human behavior.
Let me walk through a practical example to see if I understand this. The system looks at my historical data and realizes that every Tuesday at 6 p.m. for the last 3 years, the speaker group designated kitchen has initiated a specific Spotify playlist.
Okay.
So eventually, the anticipatory design takes over. It just starts fading that playlist. And automatically, the moment the motion sensor on the speaker detects movement in the kitchen at 5:58 p.m., I don't touch my phone. I don't speak a word. The environment just adapts to my historical preference.
Exactly. It is synchronized ambient intelligence. But there is a massive catch, and it is the single most important factor in this entire strategy.
What's the catch?
This level of intimacy is only possible because Sonos occupies a highly privileged, highly sensitive position in the consumer's life. They are a trusted platform.
People willingly allow these listening devices into their most intimate private spaces, their bedrooms, their living rooms, their children's playrooms.
If a company violates that trust, if they are caught selling that data, or if the system misinterprets a conversation, or if it feels invasive, the consumer will unplug the devices immediately and never buy another one.
Sonos' entire ability to execute on anticipatory design rests fundamentally on maintaining that absolute consumer trust.
Which loops us right back around to the crisis of 2025 and why growth dimension number 2, customer advocacy and aggressively fixing the broken app, was so existentially important for the survival of the company.
It really was.
If I pull out my phone to adjust the volume and the app crashes, I fundamentally do not trust your engineering. And if I don't trust you to run a simple volume slider, I absolutely, unequivocally do not want your AI algorithms guessing my mood and taking over the audio environment of my living room.
Reliability is the bedrock of trust, and trust is the prerequisite for AI.
It is a perfectly interconnected strategic web. And briefly, to close the loop on their AI strategy, the third layer Conrad mentioned was internal productivity.
Right, which isn't consumer-facing at all.
He highlighted the rapid industry-wide acceleration of AI-driven software development tools, things like AI coding co-pilots. By deeply integrating these advanced tools into their internal engineering workflows, Sonos developers can write code faster, identify complex network bugs quicker, and drastically speed up the overall pace of innovation.
So they are using AI to help build the software that ultimately runs the AI. It's incredibly meta.
But from a financial perspective, you can instantly see how that acts as a massive multiplier on their operational efficiency. If your engineers are 30% more productive because an AI is checking their code, you can do significantly more with fewer resources.
This loops right back to the beginning of our conversation. It is exactly how they maintain that incredible 24.2% EBITDA margin while keeping their operating expenses suppressed.
It creates a self-reinforcing flywheel effect. Better internal AI tools lead to faster, more reliable software updates. Reliable software builds consumer trust. Consumer trust leads to ecosystem expansion and new hardware purchases.
Ecosystem expansion generates the massive contextual data needed to train the anticipatory design algorithms. And when the anticipatory design makes a home system feel truly magical, the customer lifetime value skyrockets, generating the cash needed to invest back into the internal tools.
That is a brilliant synthesis of the entire corporate strategy. So as we prepare to wrap up this deep dive and put the final pieces of the puzzle together, let's briefly look back at the incredible journey we've covered today.
Sonos took what was arguably one of the most difficult, chaotic years in their corporate history. They tightened their operational belts to an extreme, almost painful degree, and they hyper-focused all their energy on fixing their core software foundation.
They survived a 300 basis point tariff hit through sheer pricing power. And now they are utilizing a brilliantly sneaky Trojan horse strategy, aggressively lowering the price of their entry-level Era 100 speakers to capture millions of budget-conscious new users, while simultaneously wooing high-end professional architectural installers with the Amp Multi to capture the luxury real estate market.
And they are executing this complex multi-front war while navigating a K-shaped macroeconomic environment, all to position themselves to capture a massive, dormant, multi-billion-dollar ecosystem opportunity.
The $12 billion mathematical upside of their existing installed base is the North Star guiding every decision they make.
So after dissecting all of these transcripts, all of this data, and all of these strategic maneuvers, why should you, the listener, ultimately care about any of this?
Whether you are an analyst trying to value a tech stock, an entrepreneur trying to build your own resilient business, or just a person standing in an electronics aisle trying to decide how to outfit your living room, the Sonos Q1 2026 playbook proves a vital, undeniable point about the modern economy.
Creating a sticky, reliable, deeply integrated ecosystem is infinitely more profitable and defensible than just selling isolated widgets. It is the profound difference between chasing a one-time transaction and building a lifelong relationship.
It underscores the absolute power of structural operational discipline. As CEO Tom Conrad clearly stated, the goal of the company isn't to chase a single blockbuster quarter or to manufacture a hype cycle for a single product launch. The goal is sustained, coordinated, systemic action.
It is the steady, highly complex, and often unglamorous work of building durable growth from the inside out.
It really is. It is the hard work of building the plumbing before you decorate the house. But as we sign off, I want to leave you with a final lingering thought to mull over a slightly more philosophical question that builds on the incredible technology we've discussed today.
We spent a lot of time analyzing the future of anticipatory design. This compelling vision that the intelligent home will perfectly tune our environment, seamlessly analyzing our habits, and always knowing exactly what we want to hear before we even have to ask.
From a technological standpoint, it sounds like a frictionless sci-fi utopia. But if that vision truly succeeds, do we lose something vital in the process? If the algorithms become our flawless, omnipresent personal DJs, effortlessly anticipating our every mood, do we lose the active, sometimes frustrating but deeply human joy of musical discovery?
When the home becomes a perfectly automated soundtrack tailored to our historical data, do we lose a little bit of our own intentionality in how we experience the world?
That is a profound philosophical tension that all consumer technology must eventually wrestle with. The friction of having to actively choose what to listen to, or having to dig through a crate of records, or endlessly scroll through a digital library is very often exactly where true discovery happens.
Removing the friction might inadvertently remove the serendipity.
Exactly. Sometimes you genuinely don't know what you want to hear until you stumble blindly across it. You have to get lost to find something new. But regardless of how that philosophical debate plays out, and regardless of what the future holds for AI in the living room, one thing is abundantly clear about the business of Sonos right now.
The defensive maneuvers are complete. The dust from the renovation is finally settled, the foundational plumbing is fixed, and the house is, without a doubt, in order.
Thank you so much for joining us on this incredibly detailed deep dive, and as always, keep questioning the world around you.